Good turnout? Is it a good
Yeah,
turnout?
yeah.
I
Hey,
mean, I can't
great
see.
turnout. Great turnout. Lots of people joined us, and everybody's just absolutely awesome on here. So, but everybody, I'm glad we're back. You are in for a treat. Somebody who has a passion for really helping other real estate investors do some amazing things, especially in the note space. And in the 15 years that this lady has been a full-time real estate investor, she's originated hundreds of owner finance notes. She created Capricorn Mortgage.
Not Capricorn.
Not Capricorn. Sorry about that. Capricorn Mortgage to buy performing owner finance notes and has traded over 26 million in notes in just the last 3 years. A good friend of ours and somebody you're going to enjoy learning from. Like I said, she's got a passion, but absolutely just a great person overall. And so we're always honored to have Kristin Gerst join us, I think, for the second time on Note Camp.
Yeah, second time. Second time. My last time was what, a year and a half ago? So yeah, it was fun.
It was 2 years ago, actually.
2 years ago, yeah. No Camp.
Yeah, so we are honored. You're going to share with people how to make huge profits investing in performing mortgage notes.
Right.
And people are like, are we going to see some performing notes for sale? And the answer to that is not just yes, it's hell yeah. We're going to see
hell yes. If anybody wants to, anybody ever wants to buy a performing mortgage note, yes, absolutely. I am here to meet that need. So today, yeah, talking about huge profits in investing in performers. Most people in the note space, as we know, are not in performing mortgage notes. They're in non-performing mortgage notes. They're an investor and they're just starting off. We're going to go through, if you've ever owner financed a house, you are already a note investor. So when I started out in this, I was originating, and there's a lot of profit there. But when you're going forward, yeah, it's going to depend on time and money.
Yeah.
So
one of the things we asked here, so you have a little bit of a feeling for the group. We have an attendee survey, and a large chunk, about a third of those attending have filled that out and answered the questions. And we always ask, what niche are they in? Well, 58% of those that have filled out the survey are definitely interested in performing notes, and 40% of the total attendees are interested in owner finance notes. So we got some interest, and we're delivering it the queen of selling owner finance notes right here for you, everybody.
Anyway, so in this presentation, I'm going to even get into how you can wholesale invest in performing mortgage notes by wholesaling them. So it's not just because, that's the one barrier to entry with performers, is it takes capital, and it takes a lot of capital. So, how do you get to that point? So why do I love performing mortgage notes? Less work. When I buy a performer, it's done. It's ready to go. Do I still need to go do all my due diligence with documents? Yes. And there's even more than doing non-performing notes. Do I have to have it set up with my loan servicer? Sure. But it's not, that's not, that much worse. As far as risk goes, it is less risky, in my opinion. The reason for that is when you buy non-performing notes, there's a lot that goes into timeline. Whereas performers are all set to go, they've been making their payments sometimes for several years or many years. With non-performing notes, they haven't been making them, and you really don't know exactly if you're going to be able to get them out of the house right away, or if you're going to be able to get them modified and reperforming right away. With the advantage to performing mortgage notes, you kind of take the guesswork out of it, and you start making money from day one of owning it. And that brings us to known cash flow. When you buy a non-performing note, you really don't know what your cash flow is going to be, what your return on investment is going to be, until you're already in the deal. And I have looked at non-performing notes and almost bought them, and then go, I'm gonna check out with a realtor and just kind of see if they know, this area of town, these properties, and come to find out, oh, that house doesn't have a road 6 months out of the year. So if you buy a non-performing note like that, I would have ended up probably just putting it in the trash or selling it at a loss, because I didn't know about that road. But with performing mortgage notes, they're already performing. There's no reasonable expectation that they'll stop performing as long as you do all your due diligence and talk to the borrower. So you know what your cash flow is, less work, less risk. Who invests in performing mortgage notes? Graduate level investing is basically how I call it. What do I mean by that? By the time you get to this, you've probably already originated a bunch of your own owner finance notes. And so you've got a good amount of capital coming in every month. And so the idea is that you have more time than, or you have, excuse me, more money than time. Switch that around. Less time than money. So when you have a lot more money coming in and you're like, gosh, I need to put this to work. How do I, how do I do it? And some of the fastest ways are buying performers that are already performing that you don't have to do anything for. Private individuals, I sell to private individuals all the time in cash and in their IRAs. The majority of my business goes to banks, REITs, hedge funds, and insurance companies. People ask, how am I able to pay so much for my performers that I'm buying? Well, I package them all up. I might buy one or two from an investor, and then I package them all up and I sell them to, say, a REIT or a hedge fund that will only talk to me if I have several $1 million on a spreadsheet. So that's always my goal, is to have, we'll call them A-rated owner finance paper. In the world of owner finance, or in the world of mortgages, owner finance is another answer to subprime. So if you think you're going to ever be rated, you're like, oh, but this borrower pays on time every time. It's still, because of how it was originated, is never going to be rated AAA paper. So this is scratch and dent. Even if it's beautiful and there's no reason to assume it's not going to keep performing, it's still scratch and dent paper. So let's talk about the parts of a mortgage note, just in case you haven't looked at one. When I start doing my due diligence, I have a spreadsheet out, and these are all the things that I'm going to put on the spreadsheet. I'm going to start with the address of the property that the note is secured to, and then I'm going to go through and I'm going to fill out just the important parts of the note, and I'm going to look at, it's usually within the top couple paragraphs that you'll get this information. The original principal balance, the interest rate, amortization schedule. I will run those based on what all of these details come into. You'd be surprised, especially on owner finance paper, but not just owner finance paper, but bank paper as well, that somebody made a typo and the principal and interest payment are wrong. And so all of that stuff you need to know ahead of time, so that you can get, before you buy a performer, so that you can get any corrections made on that note and deed of trust. When the date of the first payment is, maturity date, so how long it is, and that'll tell you, of course, how long it's amortized over. What the monthly PI payment is, and again, always verify it from all of your other information. Never go just off the note itself, because it's not often, but probably 20% of the time, I will see incorrect data on the actual note or deed of trust. And then when you're looking at all of this, remember that your interest, whatever you're getting paid, that part of the monthly principal and interest payment, that interest is your profit. The principal, you are not taxed on. So you're only taxed on the interest that you earn off that note every month. The principal is, of course, reducted from what you're owed if they were to refinance or pay off soon, and thus you're not taxed on that. So the interesting caveat with note investors for that is that if you, I have some note investors who right now don't want to pay a lot of taxes because they're in a very high tax bracket. But what they do want is the monthly cash flow off that note. Because your monthly PI payment, that stays the same throughout the life of the note. So, but if you get to the second half of that note, those you're going to pay a lot less in taxes, but still get the same amount of cash flow. So it really depends on what the goal of the investor is. Some just want as much interest as possible. Some buy on yield, so they're going to look at that interest rate and they will estimate their payments on that. So things to consider when buying notes. And these are just things that I look at anytime I'm about ready to buy a note. The number one thing, performance history. because we're buying a performing note, which means that we're paying top dollar. And it's, you know, my note buyers are buying 97 to 100% of unpaid principal balance. They want to know that that performance history is good and solid. Second most important thing, especially in an environment such as now, is loan to value. I think everybody knows that we are expecting that we are going to go down in value, real estate values here in the next probably 6 to 12 months. When that happens, when values creep down and you know, you're looking at loan to value. So if like I'm purchasing a note right now, I'm going to be really strict on that loan to value, meaning what's that unpaid principal balance amount, what's left on the loan, compared to what's the value of that property that it's attached to. And that's the loan to that value of that property. So you want to make sure that, you know, you've got at least 20% equity. And right now I'm even looking at 25% equity, because I know that if we have a 5% drop here in the next, you know, 6 months, or a 10% drop, I want to make sure that if that loan goes bad, that I have enough equity between that note and the value of that house to be able to sell it and get all of my investment back. Type of property matters as well. So when people hear, okay, she's paying, you know, 90 or 92% of unpaid principal balance on a piece of property, that's for single family residence. Right now, you know, if you brought me a performing mobile home note, no, you're not going to get something that high. Note investors know, one, a lot of things can happen to a mobile home. And don't get me wrong, there's some great mobile homes out there. But there's a lot more that goes into it, and the laws are different. And so when you get a mobile home, a lot of people know that, you know, they might have picked up, you know, that mobile home and that piece of land for, you know, 25% of what they sold it for. So if you're doing it, it's a great business. Nothing wrong with it, but just don't expect to, one, easily sell that performing mortgage note. And two, for anything, you know, they're probably going to go for around 50, 60% of unpaid principal balance. Is there a question on that one? I just saw one pop up. I'm not sure. Okay, continuing on. Borrower credit has recently become very important. Borrower credit, it used to be, you know, maybe 50% of my buyers looked at the credit score. And if they did, it had to be a minimum 500 for the majority of them. Right now, it's a minimum 600 credit score for the majority of my buyers. It's not all of them. You know, some of my, especially my private individuals, you know, they're going to look one-offs on, you know, is this borrower making all their payments on time? You know, what does their actual credit report look like? If I'm selling to an institution, you know, those loans are going to get packaged up into even larger tranches and sold as mortgage-backed securities. And when you're looking at that, they will just run down what those, you know, what the credit scores are of those borrowers, so they can't have a borrower on there that says has a 460 credit score. They're just, you know, they can't do that for their own selling. So a lot of them won't look at it or touch it. I do have some institutional buyers who have no intention of selling off these notes. And so for them, a lot of them are a little more flexible on credit score. But most of them have gotten pretty strict in the last month or two. As soon as credit tightened up, people were going, yeah, we can't just do a 500, we need a 600 now. One of the big indicators of success of a performing note is how much the borrower put down as a down payment. So when you're looking at, the only way to really know for sure of how much they put down for a down payment is by looking at the closing statement or the HUD-1, which is why I always request those. And so you can see exactly how much cash they brought to the table. The going rate, right, you know, the rule of thumb is a minimum 10%. So you will see a lot of originators that are like, oh, well, this borrower has, you know, 3 or 5%, and for whatever reason, you know, they just wanted the deal done, or they were desperate, they decided, okay, that'll be good enough. But when I see that on a HUD-1, I get a little nervous if I see less than 10%. And quite frankly, a lot of the notes that I see have more than 10% down, almost, 10 to 20% on average. So length of loan versus age of loan. So when you're buying, you need to know what type of investor you are. Are you one that doesn't want to pay a lot of taxes? Well, then you might want an older loan. If you're one that wants a higher profit, because all of our profit is front loaded on notes, then you probably want a shorter term loan. And just looking at how long it's been going. I mean, I have notes in my portfolio that have been rolling since 2009. And are they great notes? Yeah, I love them. Am I now past the point where a lot more is going to principal than interest? Yes. But, I'm still making 9.5%, 10% on it. So, I'm still happy with it. Cash flows, I don't have to do anything. So it doesn't bother me. Note servicing fees. This is one of those things that I get a lot of notes in that are being serviced by the actual lender. The individual, the owner finance person is servicing their own note. This is nothing. You should never service your own notes. I have never once, including myself, I mean, I am not qualified to service notes either. And I have never once seen a single investor do it correctly, unless they are a licensed note servicer and they have the correct software. So make sure and, be careful when you're buying. I have been defrauded, and this was a year and a half ago. And I got in a complete payment history with copies of money orders, and it was completely fraudulent. He photoshopped it. So, provided bank statements. The thing looked real, looked legit, and, actually got that note. And that borrower in reality hadn't been paying, hadn't made a payment in, I think, 2 or 3 months. And consequently, that's been a troubled note in my portfolio. And so I'm really careful now when, I go in and I look at, how, who's servicing it. And if it's not serviced by a licensed third party, I am really scrutinizing it. And a lot of times I'll just walk away. So I highly recommend, if you're thinking about selling any of your notes or anything you're doing, get it into note servicing. At the very least, so you're, doing everything correctly and you're compliant. But if you started off at the beginning of a loan, your borrower is going to pay for those note servicing fees. If you bring it into note servicing, after the fact, well, then the lender is paying for those note servicing fees. If that's the case, I'm not going to, there's no chance that I can buy it and or sell it at 100% unpaid principal balance, because even that $35 to $50 a month, whatever that note servicing fee is going to be, that's taking from my yield. So, just where I thought, oh, I'm buying a 9% note. Well, I'm not buying a 9% note. In reality, I'm actually buying like an 8% note. So, make sure you know who's paying those note servicing fees when you look at it. All right. The thing I love about mortgages, number one thing, amortization. So amortization tables are the same regardless of where you look at it. And after year one, so this is after 12 on-time payments, if you look down at the very bottom of principal paid, right? We're just talking about principal paid. It's $48.47 out of that $877.57 monthly payment. So $48.47 is reducing their amount, and $829.10 for the 12th payment. That's your profit, is $829.10. After a whole year, the principal pay down is only $555.88, whereas the interest on that note that you've been paid for after 12 months is $9,975. So you can see, even if you don't hold that note for, even if you only hold it for 12 months, you still make money. After year 5, this is where it gets fun. So you're 5 years in, and your total interest paid has been $49,228.61. but the only amount of principal that's been paid down is $3,425. So you are making an amazing amount of money on this note. And if you can get them to refinance out or you sell it at this point, you know, you're still regaining most of your principal. At the 5-year mark is about where it starts to creep up a bit on you. And it's not as lucrative as it is in the first 5 years. This is why you know, on your own mortgage, once you've had it about 4 or 5 years, you start getting hounded to refinance by your bank. And that's whether interest rates are good, whether interest rates are bad. You know, they will even give you, you know, a break sometimes on that interest rate, because they know that first 5 years is primarily 100% profit to them. After 10 years, so now we're at the 120, you can see that instead of having just, you know, 3,500 to 49,000, now your total interest paid is 96. You know, you're still making a great return and you're still getting a lot of money in up through 10 years. But, you know, you've still paid down about $9,000. And so you can see that, you know, in the first 5 years, it was $3,400 was paid down. And then going down, you got 9,000 in this, you know, second 5 years. So, well, that's a difference of $5,600 thereabout. So 3,400 to 5,600. So you can see it kind of pick up steam. And that's the beauty of an amortization chart, you know, really knowing when you're buying that note in what, you know, is it 2 years down the road? You need to see exactly, you know, are you going to keep it forever? Possibly. Do you have a goal to only keep it 2 years and then you're going to want to sell it yourself? You kind of need to look at that and go, all right, you know, where can I afford to do that? Is this a note I can afford to do that with? So can you profit from short-term holds? Yes, absolutely you can. And I've had some great examples at, you know, at Capricorn, where, you know, you're buying and selling notes and for whatever reason you hold it, and you end up making so much more money than you ever expected on the thing, you know, only by holding it. So this one is one that I did a couple years ago. Unpaid principal balance, 108,000. Purchased it March 1st and sold it November 15th. Basically held it for 8 months. 8 months. And at the time, I wasn't happy about that because it tied up a big chunk of my capital to do that. But principal and interest payment for this thing was $945 for 8 months. I didn't have, you know, the borrower is responsible for taxes and insurance on the thing. I didn't have any debt on it. It was pure cash. So it just made me, you know, $7,500 for holding it for 8 months. And then when I went to sell it, it was a decrease in principal of $368. And that's where I'm going, wait a minute. So I'm also only lost $368 on this one. And I ended up making, you know, almost $7,200 in 8 months. That's a good return, you know, return on investment. The reason why this one was so attractive was because it was only 2 years old, but it was amortized over 35 years. So before we were looking at amortization table of a 30-year note, and we saw that the first 5 years were practically, you know, practically all interest. Well, if it's a 35-year, even fewer payments go to principal. So, you know, at first I was, you know, my institutions don't really like 35-year notes. But my private investors, once I explain this to them and they see, oh my gosh, yeah, this is great, because if I decide to hold it 2 or 3 years, I can easily sell it and I really haven't lost that much in principal and my profits are huge. So steps to buying a mortgage note. You are going to collect documents and research the property. A lot of times I cannot get documents to save my life from a note investor. Sometimes it starts out with just the spreadsheet with, you know, the summary on it. I try to be, you know, as easygoing as I possibly can up until the point we come to an agreement and we're going to contract. The one thing I do order that I suggest that everybody does, order a BPO, which is a broker price opinion. It is a drive-by appraisal. So the broker will drive by the property. You can't get inside because, it's kind of like if Bank of America holds your mortgage and they showed up at your door and said, hey, we'd love to check out the inside of your house. We're thinking about selling the note. You'd be like, no, get off my porch. You're not getting inside my house to see it. It's the same thing, with us going in, buying and selling notes. We don't get access to the inside, but we can learn a lot from the outside of the house. I've shown up or not me, but I've gotten a BPO of photos, and I've looked at the roof, and there's a tarp on it. Well, that's telling me that there's a lot of damage there, and they haven't had the roof replaced, and probably the inside is not much better. So again, you just have to kind of weigh that, how's the lawn kept, what's in the surrounding areas, what's the rest of the street look like. A lot of that will go a long way to just determining value. So, but very important step is to know how much that property is worth and to have somebody put eyes on it. I've had instances where somebody tried to sell me a performing mortgage note for whatever they claim was performing. And I had somebody, do the drive-by appraisal, and there was no house there. It was, gone. The city had torn it down. So once you do all this, you're going to make an offer and agree on price. And with buying a mortgage note, and we'll get into the example of this coming up, but just a small note, we never give a solid number when you're buying a performing mortgage note. I know when everybody's used to buying REOs or just a regular piece of property, you're like, oh, okay, I'll pay you $70,000 for that. You can't do that in performing mortgage notes because every day that dollar amount changes. And maybe you're going to be able to close in 2 weeks, or maybe you're going to be able to close in 6 weeks because of unforeseen title challenges, or maybe you don't get all of your documents. Maybe the lender has lost the original note and you need to go get that re-signed by the borrower. All of those things can tie up a sale. And so when you're making your offer and agreeing on price, you need to do it as a percentage of unpaid principal balance. So that's the only way. A lot of sellers, with their notes, they're like, well, how much is that dollar wise? So you kind of can give them an approximate number, but note sales are done in unpaid principal balance. And contract the note for sale. There's no real standard contract. I created my own, and then I had my attorney look at it. It's, basically you've got to start it from scratch and, lay out all of your terms. And verify all documents are error-free. So you need to, get every single document that you need from the seller, and then you need to read them. If you are not qualified to read legal documents, hire somebody. There are a ton of legal secretaries who can read those documents and can look for the errors. Is the name of the borrower and seller correct on the deed of trust and the note? And these are the two that are super important. I've seen deeds of trust that had this phantom woman, and it was actually a single man, and it says, oh, this guy's single man, and then it says spouse, and it's this woman. And she actually has appeared on about 4 or 5 different deeds of trust because apparently her name just wasn't deleted when they were originating these notes, and so it was just kind of in the template. So make sure when you're buying these things that you do read them. The time to verify and get documents changed and all of that is before you close. That seller who's selling the note wants to sell, wants to close, and so they will be very agreeable to helping get all of these documents, making sure they're right, and making sure that you have original documents from the borrower. Anything that you need to get that deal done will be, you'll have a much better chance of getting it before you sign on the dotted line and wire funds to that seller. So once you find your errors, and you have to correct any errors in documents. People have always asked, well, what happens if you find these errors? It's actually pretty easy. I always close at a title company with an attorney, and the attorney will find it, and she'll do affidavits as needed and just make all the corrections. You are going to complete your note sale, and then you're going to set up note in note servicing, whatever note servicer you love. And one important thing in setting up note servicing, a lot of times they need a goodbye letter or a copy of the goodbye letter from the seller. So make sure that you're communicating with note servicing, your note servicer, before you close, because they're going to want a copy of that document, and you need to make sure that that note servicer has everything they need. So documents needed: copy of the recorded deed and copy of the recorded deed of trust, and copy of the recorded warranty deed. Why recorded? A lot of times, your end buyer for these notes is going to be an institution. So I have standard rules in place because I don't know who's going to buy this. This is not necessarily a rule for a private investor, but for all of my institutions, yeah, they want to see that, the deed of trust and warranty deed were recorded in a timely manner. I've had, a bunch where the deed of trust and the warranty deed were never recorded. And in that case, they're going to, whoever you sell that note to, or, if in the, eventual future you decide to sell the note, that's going to come up on the question. And when I see it, I think, one of two things instantly: either sloppy transaction by the attorney. So when I see that things aren't recorded, I'm going to go through everything, 2 and 3 times to make sure nothing's overlooked on errors, because obviously if the attorney didn't get around to recording these documents, they're not a very good attorney or title company. And so the entire transaction could be sloppy. The other thing is, if the investor or the originator decided, oh, I don't want to record these documents because then it'll make it easier to foreclose on this borrower, that says shady to me. I'm also going to tear apart this note deal. So just know that. I instantly think one of two things, sloppy transaction or shady originator. And it's usually shady originator, the one who thought, oh, I can just sneakily get away since it's not recorded anywhere and they won't have evidence of it. I can just evict them from the house. And it doesn't work like that. And especially here in Texas, if you don't record your warranty deed, it's still a legally binding document. And I'm not sure that they would have a copy of it. They were probably never given a copy of it. But going in front of judges, they're going to ask, and they'll be like, no, I signed these things, it was a legal sale. Copy of a closing statement, again, so you can see what their down payment was. The RMLO package or borrower information. This is something you need, and sellers are reluctant sometimes to give over documents that have their borrower's credit information on them, like their birth date, their date of birth, and their social security or ITIN number. When you're looking at this, you have to be able to go verify that that social or that ITIN is a correct number and belongs to that borrower. You wouldn't believe the amount of times that I get packets and they just fraudulently stuck a number on there, and in fact they do not have a social security or an ITIN. That borrower, that note is not going to go to an institutional buyer. That will only go to a private investor at that point. It'll still have to have a really good payment history, but you're just, if it's not an official package. As far as the RMLO package, it's required by law and has been since January 2014 to have an RMLO package. The amount of notes that I have that I see that don't have one, and in fact the lender did basically zero due diligence on the borrower and didn't get any documents, is staggering. Or possibly they got documents and they lost them. In that case, we still need to verify their social and their date of birth. A lot of times we will, just ask for, a 1003B, just, get something filled out. So we have as much information on the borrower as possible. It would basically try to kind of build a file, for lack of a better word. It's always better. The note is always a much more marketable note if you have an official RMLO package on it. And then you also verify that that social or ITIN belongs to your borrower. And not all RMLOs verify that. And I'm just going to leave that there. Be careful with that, because I've gotten notes that had RMLO packages on them, and then when you actually went and looked at the borrower information specifically, it was a fraudulent number, and there's still this report. Always get proof of insurance and proof of paid property taxes, especially if it's being serviced by the lender. There are so many times where, the lender, for whatever reason, instead of saving those escrow funds that they collected from the borrower, didn't have any money to pay property taxes when they came due. So that's a big no-no, but just keep that one in mind, that you do need to verify that all property taxes have been paid. And if you close out a title company with an attorney, you will be able to, they're going to check that for you and make sure. Next one, the other one, proof of insurance. We see this a lot, and I mean a lot, where, especially if there is an underlying lien to the property, the insurance is not in the borrower's name. It's in actually the lender's name, or whoever was on the original mortgage that was wrapped in a subject to transaction. You can't have that. You've got to have insurance in the borrower's name. And I have, of course, I've learned the hard way on that one. It's a nightmare if you need, all of a sudden your borrower needs a repair, like there's a bad roof. And that's, the couple times it's happened to me. I also had a situation where the borrower's house got flooded, and I was the name on that insurance. And so I had to go there and basically, pose as the homeowner. So you do not want to get in a situation like that, where you might not get the rehab funds because of, having the wrong or incorrect name. I also did have one situation where, they did bring it to my attention, but they were a good enough insurance company that they didn't use that as an excuse not to pay benefits. And so just, you get what you pay for. Loan servicing information. If you're buying this note, you're going to need to know who's servicing it. The rule of thumb is if it's not broke, don't fix it. I have all of my notes serviced by my note servicer. Anything I buy, I'm going to transfer regardless. If you have one or two and don't mind dealing with a couple different companies, probably, not too bad if you leave it there. Totally up to you though, and it's up to the lenders. It's up to the lender to say, okay, yeah, I want to get rid of this, or I want to move it, or I'm going to keep it here. Original signed note. Why do I have that underlined? And original assignment and allonge. I underline those because while some end buyers or some institutions will accept a certified copy of that note, not all of them do. So when I'm closing on a note sale, I insist on having an original signed note. How often are those gone? A lot. Unless they've heard me speak and they know that, okay, I need to have that original signed note. People will get their entire packet of closing documents mailed to them. And I think a lot of times they throw it in the trash because I think they're like, oh, I've got the soft copy of it. I don't need this. It's just taking up space in my file cabinet. You at least need to take your original signed note and any assignments and allonges that are attached to that note and put them, get them in a fire safe, get them in a, bank safety deposit box. But for crying out loud, don't throw those away, because that's what you're buying and selling here, right? That's what you've created. And that's, that note, that mortgage note is, that's what you have, that's what's worth money here, money to you. So, make sure and just don't go, oh, I don't want it, I'm going to toss that. So an example of a mortgage note that, I don't know, I bought this one, I don't know, last year sometime, had 132,317.66 unpaid principal balance, appraised at 190, which is nice, right? So I'm looking at this going, oh yeah, it's an awesome note. 7% interest rate. Wah, wah, wah. Very sad to see that. Anything less than 9 and 8.5, 9. If it's 8.5 and it looked like this, I wouldn't discount it. But anything less than that, I'm going to start taking off points from my offer. The reason for that is, 9% is acceptable to most note investors. The ones that have more money than time, and they're looking to purchase this. But you get below 9%, a lot of them too, they want double-digit returns. So, and there's times like, I pay a lot for performing mortgage notes. Why? So I can buy millions at one time and send them to my institutional buyers. It turns my profit margins, to 3 to 5%, really 3% after all of my overhead. But, I'm able to do a lot in volume. The average note, the note wholesaler or, the average note investor might only do 1 or 2 a year. And in that case, they're buying them at a lot less than what I am, usually about 10 to 15% less than what I do. It's so, they've got a little more room to play with those offers. For mine, I'm awfully bidding high, unless, I see something like this come down, and then I'm going to, start hacking down my deal a little bit. Principal and interest per month was great, $897.37. Doesn't really matter, to me what that number is, 7%. 336 remaining payments, which would, if it went to fruition the whole way through, it would be $301,000, giving you a profit of almost $170,000, which is phenomenal. Majority of notes don't go to the end, and we don't expect them to. Do some of them? Sure, of course, but eventually they'll just start paying it off and paying it off quickly. With this, every month that you keep it, you need a couple months, because if you decide to sell it right away, you could have some minimal closing costs. The one nice thing is when you go, let's say you hold something for say 6 to 12 months, on your second sale, as long as there was title policy and lender's title policy on that front end, you could really just prepare an assignment and a allonge and assign it to somebody. Once you do another title run, making sure that there's nothing else on there, because that lender's title policy that you had when you purchased it goes with it for the life of the loan. As long as you're not, the loan's not refinanced or something like that. Lender's title policy travels with it. So you just have to make sure that you have a lender's title policy on it when you buy it. So how to bid on mortgage notes. As I said before, offering on a mortgage note is done by percentage of unpaid principal balance, or UPB. You'll hear people say UPB all the time. So a 97% UPB offer on a note that at the day of closing had an unpaid principal balance of $132,000 would be a sales price. You just take 3% off of that. If you have problems remembering how to do that, you multiply, 132 times 0.97, and that'll give you that 128 number so that you can figure it out. Most of my stuff is automatically done in, an Excel template. So, wholesaling mortgage notes. So for all of you out there new to note investing and trying to figure out how to learn how to get your feet wet, the biggest thing is being able to bid these notes. If you send me something in Texas, if it is a Texas performing mortgage note, I can look at it and give, I can look at the line. If you give me a spreadsheet and it gives me all the information that we talked about earlier, I can tell you what I can pay for that note in about 2 minutes. And it doesn't take me long, and I know exactly how much all of my institutional buyers will pay. I know the likelihood of which institutional buyer it'll go to. So I'm confident in that. When you're first starting out, you're not going to be that confident. In fact, you're not going to have any clue. You're going to be like, oh my gosh, I have no idea what somebody would pay for this. So, you would probably want to do this around the time that you're also marketing for notes, but you want to build a legitimate buyers list. Why do I say legitimate? I am very, I created Capricorn Mortgage Investments back in 2016 and 2015, 2016. And I did it as an answer to, I had this huge portfolio of owner finance notes. And I was, answering all of those little websites and going, oh, how much will you pay for my note? And inevitably I get a call back and they'd be like, oh, great. Yeah, we're going to pay you, 85% of unpaid principal amounts. And I was like, well, okay. Yeah, that's pretty okay. Then I'd sign a contract. There would be no end date on that contract and it would just go. And so 3 or 4 months would go by. And then I would get, I'd be calling the guy and going, are we going to close this thing? Why is this thing, taking so long? And he'll be like, oh, I'm really sorry. Yeah, I can't actually pay 85. I can only pay 65% of unpaid principal balance. And I'm like, what? Why? And that happened time and time and time again. So what I have found is that the majority of note buyers out there are pretty much full of it. And, they'll tell you, oh, yeah, no, notes. Sure, I know all about notes. They won't know the terminology. They won't actually have any buyers, but what they'll do is go, oh, sure, I can take that note and I'll go find you a buyer. How hard can it be? In reality, it is not the easiest thing to do. And so you do want to build a legitimate buyers list and know who's actually out there in the market really buying notes, and ask for references. I have no problem giving references and saying, hey, yeah, go ask this person, or here, go ask this person. I have people who will vouch for me that have said, yeah, she's closing on a ton of notes. But again, know who that is. And if the person isn't willing to give you any go, yeah, if they haven't bought anything and they can't tell you who they bought it from, well, they're not a real buyer. What they are is, a daisy chainer. And so you'll see this a ton in the note world, in the note space, where, some guy will put it out there on, say, Facebook, and he'll get all of these DMs and they're like, oh yeah, send me the note. I want to buy it. Well, he's just sending it off to some other guy who says he's got a buyer, who says he's got a buyer. And what they do is they end up tacking their fee onto it. And so you end up with this oversold note, and then nobody's going to buy it.
Don't you hate daisy chains?
I do. And I insist on being direct to the seller now. And the amount of times, and I'm finding it's not just for performers, right? Performers are a little easier because you can talk to the originator. Non-performers that are coming from servicers or coming from banks, those, you're getting a list of 1,000 notes, that are non-performing, and they're from all over the place. And those are just daisy chained all the time. And so now I'm like, because I did a round about 3 months ago of non-performing notes, and, just myself and my group, and put in close to 60 offers. And I realized that this guy I had been dealing with, who said he was direct to the seller, turned out to just be some Yahoo.
Should have called me.
And as I've done that, you remember I've done that in the past. I'm like, hey, you know this, and you just laughed at it. You're like, oh yeah, I've seen that. I've been looking at that list, comes around every 6 months for the last 4 years. And I'm like, seriously?
There's a couple things. When somebody calls me and says I'm a buyer's mandate or a seller's mandate, that usually means daisy chain. You know what I mean?
Really?
Yeah, I'm a seller's
Okay.
rep or a buyer's rep. Okay, whatever. No, you're not.
Yeah, it's so, for me now, I'm building my own direct non-performing, pipeline. Does that take time? Yes, it does. And you've got to prove that you're worthy, and you've got to be able to show, cash in the bank, to be able to do that. I'm in a unique position where I can. But as far as dealing, yeah, if it comes from, if performers are coming in from wholesalers, I've got deals right now going with 6 different wholesalers who are bringing me notes. I need to be able to contract directly with the note holder, with the seller. Otherwise, it's a no-go for me. It can't be, oh, from so-and-so, from so-and-so, from so-and-so.
Sure.
It drives me nuts. I mean, and when I offered, 60 on those non-performing notes, I just never even heard back. I'm like, I just bid on, over $1 million worth of notes, and you can't even give me an answer. And I mean, cricket. And so that's when I realized, okay, this guy was, daisy chain probably a couple ways, ways away from the seller, and really just couldn't even get a response from the seller,
Yeah.
which meant I didn't get a response. So I'm like, that's enough with that.
Okay.
So when you're building your buyers list, and just beware, buyers are not in the note space. There's not a lot of them running around there. Especially if you're looking for them on Facebook. It's, word of mouth, get 1 or 2 good buyers, and you can go, you can buy, if you, I've got a blank checkbook to buy Texas performing mortgage notes, blank. I cannot get enough paper to satisfy that need. If I'm just dealing with an independent investor, yeah, he might buy one or 2 from me. I've got, bigger consortiums now of private investors, where, one group, they're wanting, 3 million right now. Another group is, wanting 1. So getting enough paper to satisfy that need is, it's always hard. That's the harder thing right now for me. But when you're marketing for notes, there are many ways to do it. Social media is a great way. I love just going out. A lot of people, I'm thankful to all of my friends out there on Facebook. As soon as somebody goes, hey, who's buying notes? I get tagged in those, especially for performing mortgage notes. So get out there and post on everything. Facebook especially, because you've got a lot of real estate investors who do owner financing. So website, and they're, my wholesale people who are bringing in, one guy has a phenomenal website, and it just brings in so many note leads. I'm totally impressed with the guy. It's great, and then direct mail. Direct mail is expensive, and it's hit or miss. So there are a couple, if you're an owner finance guy out there, you've owner financed something, you've probably seen it. First National Acceptance will send you out a letter, and I beat them by like 20% every time. So they're not one of my buyers. But they send out, I probably get a letter from them almost every week. Seems like that. And when they're doing massive direct mail campaigns, even more. So you need to make sure that you buy a good list. The first direct mail list that I bought sucked. I mean, it sucked. I don't even know what the hell I got. I can tell you right now that I never got one, postcard. But then I was getting calls from people that are like, what is this exactly? And it was like it went to like 10,000 random people, and none of which were, note holders. Negotiate with a seller. I have in there 75 to 85% of unpaid principal balance. Honestly, for wholesalers out there, that's about the going rate. I pay 85 to 90 right now. That's about where all of my offers come in. Although in the last week I've bid 92 on a large package of them, just because I wanted the deal. And, you know, if it's got a lot of volume in there, then okay, if I only make 2%, if I only clear 2% on this entire package, but the entire package is, you know, $4 million, you know, I'm still a happy girl with 2%. So just know that the going rate out there is 75 to 85%. It's actually even lower than that, depending on whose class they take. And I periodically will just stick stuff on, you know, on Facebook and go, oh, I've got this note for sale, kind of just to see where wholesalers are coming in, where these, you know, if I know that there was a note class or note education class going on, just seeing where they're gonna, you know, put an offer in on. The last time I did it, they all came in 65 to 68% of unpaid principal balance. Even though I said I'm looking for par, you know, I want 100%, they still said, oh yeah, no problem. But when it actually came back, it was always 65 to 68% of unpaid principal balance. And it was a couple dozen of these newbie note students that I met. So just know that the average place that you're probably going to get a deal accepted is 75 to 85% UPB. There's a big myth running around out there about especially owner finance notes, buying, you know, performing owner finance notes. And that is that there are institutional buyers out there that will pay 102% of UPB. That's ridiculous when you're talking about subprime mortgages and talking about owner finance loans. One, nobody is paying, you know, that much for something that will, you know, that there's a chance that it could, you know, a higher than average chance that it might default. But more often it's also the volume of notes. So any of those deals that that you might hear about, you know, yeah, has Chase Bank or Goldman Sachs, have they bought and paid 102% of unpaid principal balance? Yes, but that is for $500 million in notes, you know, or $1 billion in notes. It is not for your one that you're selling, because if you buy that note, that one note at say 102% of UPB, and then for whatever reason, a month later, that borrower refinances the house or sells the house, you've lost money. So there's not an investor or institution that's going to pay, you know, anything over what that unpaid principal balance is. So if you are ever approached by a seller and they're like, oh, you're going to sell this for 102%, no, you're not. You're really not. You know, I get 97 to 100, and a lot of that depends on, you know, the quality. Yes, the quality of the paper, but also how much they're buying. But you know, I've never sold for anything above unpaid principal balance, and you know, I have no expectations of selling subprime paper like that. So once you get your note in, and of course you want to create your little spreadsheet and type in all of that important information from the beginning, you know, details of the original principal balance, how long it's amortized over, what the principal and interest monthly payment is, what percentage of down payment was done. All of these things that you're going to need, you know, off of the closing documents from that note. Do I always get that from wholesalers? No. A lot of times, you know, I will get, you know, the summary spreadsheet from them. We'll agree on a price with the seller. All of that's good. And then after that, we contract, and then I get documents. I usually like to have documents before I contract, but you know, sometimes I'm just moving fast. So there you go. Once you present to buyers, then you get a buyer that you know, that pays you what you want. You know, you've negotiated with the seller at, you know, say 80% UPB, and you've got a buyer who will pay you 85% UPB. Well, you've made, you know, 5%. And if you're talking about a note that say is $150,000, you know, 5% is, you know, 7,500. So you can start making quite a bunch of money by wholesaling mortgage notes and, you know, just naming your own price. I'm going to go through really quickly what happens if a note gets bad, just because, you know, if you've ever listened to me before, I'm very opinionated on this one. I have had to take notes back. periodically, handful. First thing you're going to do is send out the 20-day notice. I allow my borrowers to be late one time. That's it, once. And once they've been late, I put a standing order in with my note servicer that they have to send out that 20-day notice as soon as they're late. As soon as it goes past that grace period, you know, the 11th of the month, 20-day notice goes out, because I want to be able to foreclose, or at least be in the negotiation, you know, have the upper hand in negotiations as quickly as possible. I am a big believer in deed in lieu and cash for keys. When I first started in notes, you know, back in 08, 09, when the market crashed, I had a couple go bad on me, and I was just like, I never tried deed in lieu and cash for keys. I just went straight to the jugular and filed foreclosure on them. But what happens is, when you file foreclosure on one of these borrowers, they get inundated by attorneys to file bankruptcy. And remember, those attorneys only get paid for people who sign up for bankruptcy. So you need to know that they're going to be not telling them all the bad things that can happen if they file BK. And once they file a BK on you, you can't even go after them right away. There's a whole waiting period. Then you have to hire a federal attorney to go and, you know, negotiate on your behalf in bankruptcy court, because state attorneys are not licensed in federal court, and all bankruptcies are federal. So again, there's a lot more cost and headache going into a bankruptcy. So I start with deed in lieu and cash for keys. Basically, I just go and I lay out what are your options. You know, I basically say, you're not going to be able to refinance because you haven't been making your payments, and your credit's terrible now because you haven't been making your payments. I say, you could sell the house, but you don't have time to list it because I'm foreclosing on you in 2 weeks, you know, and that's when I would file. And I always say 2 weeks. And I said, you could get maybe one of the We Buy Ugly houses or an investor to pick it up, but it would need to be a cash sale that's closed in about 2 weeks. And I said, or 3, I can give you $2,000 and you can just move out and sign the house back to me. And while I called a deed in lieu of foreclosure, I also give them another spiel going, you know, we'll just do a warranty deed, you know, because I don't want it to say deed in lieu of foreclosure. That way you can honestly say, I've never been foreclosed on. I go, and that'll really help your credit. And so hopefully in a couple years, you can go try this again and buy another house. But I basically let them know they've got 2 weeks. If they are going to take cash for keys, I say that they have to move everything out of the house. All trash has to be taken to the curb or wherever it properly is disposed of. And then they just need to broom sweep it. They don't have to do any repairs or anything like that. Make sure they know that. In 9 times out of 10, they take this. I've also had, you know, I've had a couple pay off and they just go and pay me off. Again, I'm happy about that because I don't have this headache of somebody who's not paying on time. If they basically ignore you and they don't do any of that, they don't think you're serious, then you're going to have to foreclose on them. Again, I haven't foreclosed on anybody since 2009. You will have to evict them if necessary. Pain. And then resell the property. In reselling the property could mean that you just stick it on MLS and it's retail. It could mean that you are owner financing it and you're setting up a brand new note, hopefully with a much more worthy buyer. But always try deed in lieu first, always. So I don't know, are there, Scott, are there questions?
Some questions.
Yeah.
Questions here. Good stuff, Kristin, as always. Good stuff. Hang on. So a couple questions you answered along the way because I knew you were going to get to it. Dan asked a question here. If it's a performing note, shouldn't the performance history show 100% on time? How many late payments made is an unacceptable performing note?
Okay, so they have to be current when I close on that note. You know, if a year back or 2 years back they got into something and they were paying a little late, that's fine. You know, as long as, you know, they've been paying on time relatively. And on time, by the way, doesn't necessarily mean the first. or,
Right.
the 5th, the on time means before whenever a late charge is filed. When you're looking at, I've had notes that paid slow, and they're called slow payers. So a lot of times I'll look at, all right, they're charged a late fee every month, and that's been going on for the last 2 years. But are they making a payment basically the same day of the month every month? Because I love those notes. Those notes are great. When you're looking at that, you're going, okay, I'm just getting extra money every month because they're paying their late charge. I've never comprehended it. I've had a handful of those, and they performed. So no, I don't have a problem with those. But it's looking at, are they making payments in regular intervals that are important?
Mm-hmm. That makes a lot of sense. Exactly. Are you always pulling credit before you close?
Yes.
Okay. And you're verifying social security numbers and tax ID numbers with that, or skip tracing, correct?
Correct. And you can do that a lot of times. The way I pull credit, it verifies those numbers for me.
Yeah.
And you have to do that. And especially right now, I had a note, and the investor who originated this thing, she screwed up, and she screwed up so many ways. And then she was kind of dragging her feet in, getting me stuff. And then I'm looking at it going, all right, we got to restructure this thing. So we did legal stuff to it to actually get it to sell, so the loan to value wasn't so bad. We were doing anything we could, to get to the point where she could sell it and not get foreclosed on by her hard money lender. As I said, she did a lot of stuff wrong here. But what it came down to, the borrower had a 436 credit score. And I couldn't do anything with it. I couldn't get it to go anywhere. Nobody would touch it. So credit's important.
Yeah, it definitely is. I mean, with the non-performing, we don't worry so much about the credit because we know it's non-payment and stuff like that. But we've actually still verifying the credit, credit ID, social security numbers, other things that are out there too. Especially if we're going to be doing a forbearance agreement, or looking at what else they're on time with or not on time with as well for us. Carrie asked a question: what kind of marketing have you found that has worked best for you to find inventory? And then, are you also raising private capital to acquire your notes?
Yes, on private capital, absolutely. Once you get some experience doing this, the money comes. Money comes a lot easier once you have a proven track record, which I do. And so, I've got lines of credit, and, I've got banks who contact me, who just go, hey, yeah, I caught this, and yeah, do you need money? That's fun. That's a great way to do it. As far as, what was the beginning part of the question? What the best method for finding them?
Yeah.
So I've kind of been blessed with being part of Propelio, being on podcasts, YouTube, having my own YouTube show. I haven't really had to do anything in the way of marketing. I referenced a direct mail campaign.
Yep.
It's hit or miss, but probably social media would be my best to date. But it's really networking. And so getting out there and telling people what you're looking for, because you'd be surprised, even though, I'm shouting to the heavens, that you can buy and sell notes, you'd be surprised at the amount of investors out there who are originating owner finance deals, and they don't even know that they can sell that note. They think that they're just stuck with it forever. And I know that I was like that, when I first started doing it. I'm like, okay, so it's like the rental house that I was going to have for 30 years. But, I didn't really truly believe that they were as liquid as what they are. And they're pretty liquid, once you know where to take them.
What are you using to pull credit?
I just use a service. It's through a rental company. It's pretty easy. You just go sign up for that.
Yeah, we're actually getting re-signed back up with TransUnion, actually.
So good. Yeah. I mean, and I looked into, I've been recently looking into Experian.
Yeah.
Everything, because I buy nationally. So I like to, if you just have something that's local, maybe they're only licensed to do things, in the state of Texas. Well, when you get notes that pop up, around the nation, you need to really be set up nationally. So, my BPO company, everything that I do is completely uniform, for my banks, for my REITs, hedge funds. They like to see that everything is stacked and papered the same way. So, which is why they buy from me on a repeat basis, because, they know exactly what I'm going to present them with.
So a couple of people asked a question here. What trading desks would you recommend, if there are any? You mentioned a Fanac.
Trading desks.
If somebody's trying to sell a mortgage, maybe not maybe it's not a Texas note like you like. Maybe it's another.
Right. Well, yeah, no, because again, I buy performers nationally, just so you know. I mean, I have national buyers.
Okay.
Texas is my bread and butter. What I said about Texas was I can give you a bid in about 2 minutes. I just need to look at it, and I'll do a quick CMA just to see what things worth. But 2 minutes, I can have you an offer on that. Other states, yes, there are states that are very difficult when you're a lender. And so those take steeper discounts, even when they're performing. And, I have to usually, call those. I mean, there's some states that I've gotten pretty good at. The Carolinas, for whatever reason, I have a bunch of notes that pop up there. And a lot of my institutional buyers hate the Carolinas. North Carolina stuff, hate them. But then I'm like, but then I got this other great pool of buyers for it. And so, I know how they're going to bid. Same with New Mexico, in Oklahoma, I see those quite a bit. But as far as a trading platform for them, I've tried those trading platforms. I thought, oh, here's a note, and I can't really sell it. Let's see what I can sell it for on this thing. Oh my God, no. I mean, I outbid all of those people, so I really had to go get my buyers list from scratch, and which, is, I had connections that, the average investor doesn't have.
Well, the beautiful thing too is that if you're here in Note Camp, we already know that over half those that are attending here are looking for performing notes. So you've got some people in place here to help those out there that are looking to dive into it. Scott asked the question, Scott Brown asked the question. So you make an average of around 5% on each performing note you sell. That's why you broker notes versus being
3 to 5. 3 to 5.
Yeah. That's why you're brokering notes versus being a mortgage originator.
So yeah, I have one. I'm actually planning on getting back into originations, say this fall. I'm expecting prices to go down. I'm expecting people not to be able, there'll be a lot of investors who won't make it through, it hasn't crashed yet. We haven't crashed. But we're kind of in this limbo period, and it's coming. I just, exactly when as soon as it rears its ugly head, I'm going to be in position to go and start picking up foreclosures that I can then fix up a little bit and then originate into owner finance notes. But quite frankly, I don't have the time to do that, or, the desire. I just go after performers. There was really no good market or good place to take a performer when you're an owner finance investor before I started Capricorn.
You're exactly right. The institutional side is really the only place to go for that, or knowing your own investors list.
Well, but if you're going, I started Capricorn that way. I would get a note, and then I would sell a note and it would go to one investor, and I do a lunch and learn, and okay, I want to buy a note. I've got $60,000. Okay, then I'd have a note and I'd sell a note, and that was that's not a business. It's not scaling a business. And so, the better way that I found to do it was, I've got these institutions, but to even get in, to get past the lobby and talk to these guys, I had to have $5 or $10 million at a time on a spreadsheet. And, the average investor starting out, they might have 1 or 2 notes, 100, maybe 200,000, and you're not getting to institutional buyers that way. So, then you've got to kind of, it was a little challenging for me to figure that part out. when I got started.
Yeah. Robert asked a question. How do you view reperforming notes? Do you price those differently? And is there any type of seasoning you want to see on the reperformance side to get maximum value?
12 months. I have always hated reperformers because, you know, I know that non-performing note investors are out there, and it's a very easy way. You don't have to go put the borrower through underwriting again, and you just kind of go, okay, we're going to modify this note and carry on. But I'm a big believer in human nature. And so if somebody defaulted once and then they were given this huge gift, I think human nature would prevail and they would stop paying again. That's my own opinion on reperforming notes. Moving forward with all of these people that are giving, you know, are being given forbearance right now, now is the time to start doing loan mods, because, you know, institutional buyers, you know, I haven't had that conversation per se with an institutional buyer, but I can guarantee you, if they're looking at a loan mod or just a straight note that's been performing the whole time, you know, they're taking that straight note and they're maybe going to pass on the mod unless it's a decent price. You know, they can pick it up for a lot less, sure. But that was one thing you should know about if you're going to reperform a non-performer and you're going to modify that note. Know that you're probably not getting my prices. You know, you're not going to get 90% unpaid principal balance. I'm just, you know, I'm going to discount that quite a bit.
And that's the thing that you got to realize too is, I mean, we buy non-performing and then we get them reperforming and sell them at 85, but it's got to be a good yield. If you're doing a mod at 5%, 6%, at 5%, somebody's wanting a 10% return on their money, that's a 50% discount on
exactly. And you know, and I've gotten several notes in lately, and I'm just, you know, I get excited when I get a new note coming in, and then I see that it's like 4 or 5%, and I'm like, I don't even like to make offers on that stuff. Exactly. You know, because it's like, oh my gosh, I'm gonna have to offer them like 35, 40%. You know, and for me, I try always to hit that 90, 92% mark. Always. Why? Because my biggest marketing is word of mouth. You know, somebody will be like, you know, somebody's showing off going, oh yeah, Kristin Gerst, yeah, she paid me 90%. She closed within a couple of weeks. You know, and so people will, you know, come to me just for that from other investors. So if I'm there getting caught having to offer 35% on something and that gets around, you know, I almost would rather not buy that one.
Well, but you also got to realize you've got to be, it all depends on the details of the note for the most part. Yeah, I know you want to keep the 90%. I like to pay the 90%, but it all depends on the situation for the most part. I mean,
sure.
You know, it all depends on the details and what's going on. I'll give you an example. We're seeing a lot of mezzanine loans, 12 to 18 month hard money loans, mezzanine loans that are at 70% of LTV. I mean, you know, what are you seeing as far as pricing on something like that where it's interest only?
You know, they're pretty high, 96, 97.
But there's still a discount. There is still a discount there, though.
Well, you know what? Here's the thing. I don't work for free.
Amen to that. I only bring that up because I get so many people that reach out to me. They say, oh, you're a note investor. You're a note buyer. Yeah, we close notes. But they're like, oh, I want to sell it at par. Well, great. Keep it at par. You can sell it to yourself at par. I've got expenses. Yeah. I've got money costs. I got due diligence costs.
You know, every file that I touch costs me money. So, you know, I have a team under me. There's no way that I could, you know, when COVID first hit, that, you know, probably the last part of March, I started having notes just start rolling in. I looked at hundreds, and I mean hundreds. And it's not, you know, if I don't have, you know, my personal assistant, a couple VAs, and then like my legal secretary going through all of that stuff, there's just no way.
Yeah.
And in all of those people cost money, whether I buy that note or not. I mean, just touching a note is costing me money.
Yeah. Let's see. Do you like Michigan? Do you like buying notes in Michigan?
I don't dislike it. I don't love it though. You know, anything up, we'll call it, you know, what is it? The steel belts up there, you know, they've got if they've got, how long it takes to foreclose on something, I'm going to look at that. All of that comes into play. Are they liberal? Or, are they conservative? Are they going to be on the side of the lender, or are they going to be on the side of the homeowner?
Well, I think Michigan's at a pretty fast foreclosure time frame.
It's
Are you
not,
looking
it's
for value?
not bad, but it's, it's also.
Yeah, well, that's kind of leads to where I was going. Do you like properties and notes on properties at specific market values, like 100 grand or more?
Yes. And 100 grand, like 100 grand minimum, 100 grand or more is, once you start getting down into these really small balances, yeah, you're going to get an offer from me that's, 80%, sometimes even less, even for a higher interest rate note, just because the cost to do it, I couldn't understand, like the first year that I did it on a mass scale, I'm buying these portfolios of notes and I'm just giving, one set price. But what I found was past a certain dollar amount, I actually lost money on that transaction because of all of my fees and my overhead, and costs in buying a note. And by the way, in performing mortgage notes, sellers pay the traditional closing costs, but that's not all of the costs, just the costs on like the transaction, with the attorney and the title company. That's not the only cost in doing the deal, just the due diligence and just the getting servicing set up and all of that costs money.
What would you say, if you figured out what your average cost is, if you look at, even the deals that you haven't done, what would you say for every note you've closed on been the average cost of that? And obviously throwing in cost for due diligence, the ones you kick out.
Right.
$200.
It's actually a little bit more than that. It's somewhere in the range of about $300 to $350. Because I know once I get down below 50,000, the numbers start getting really tight. So if you're talking about, okay, I've got a $25,000 note, and okay, I'm making an offer of unpaid principal balance, and I'm making 3% on that deal overall. When you look at that and you're talking about a $20,000, $25,000 note, I'm making $600. And that's before you have to then look at like all of the additional costs for the people who work for me. And so I'm like,
you're right about that. And that's when you start looking at those lower balances, you've got to start taking bigger discounts to offset those costs, because it still costs the same to foreclose for the most part, $100,000 house as it does on a $30,000 house. So it's just a bigger chunk when it comes down to.
Exactly. And I pay my people per file. I have to pay them per file, or they're paid hourly, and they can only go through as, so many files. So yeah, all of that, while my costs are set per note to actually close a transaction, I'm paying and buying on a percent of unpaid principal balance. You have to do that anyways, because, that principal balance is changing constantly. So you don't want to all of a sudden screw yourself out of several $1,000s because you said, I'm going to buy it at, 75 grand or something like that.
Yeah. When you're, are you buying newly originated notes?
No. I looked into doing that. I tried to do it a couple of years ago, and, I would love to do it, but again, it comes back to human nature. I picked 3 really good investors to do that with. And lo and behold, they brought me stuff. They put people with a pulse in there. And, I believe that, that was a big reason for the mortgage meltdown in 2008, was because these mortgage brokers knew that they could originate a loan on Friday and it was sold on Monday. Yep. Maybe even that same afternoon they were sending it over and it was gone. And so I just, that's how it was like, okay, well, we need more paper. Okay, well, let's do ninja loans now, where people don't even have to put down one number. We have no idea how much they make. Do they even have a social security number? We don't care. We know somebody's going to buy that piece of paper. So, I stopped doing that pretty quickly because I realized this is a recipe for disaster, especially because I guarantee my paper.
Well, that's the thing too. You've built systems. When you start building systems, you cut out the side projects. You get more focused because you're in your lane. You've got your systems. You streamline that, and you go from there.
Yeah, and there are times when, there are times where I'm like, gosh, I'm desperate for notes. I've got to take something, and every time I'm like, okay, well, I'm going to take that note, even though it's, something's wrong with it. Lo and behold, it just turns out to be a really bad mistake. So yeah, it's important to stay in your lane and do what you're good at and do what you know.
Exactly. We got a couple questions on contract for deeds, but you're not buying contract for deeds.
I don't buy contract for deed. I have a few, very few institutions will buy that. If you're looking to sell contract for deed, it's a poor man's mortgage. It really is. It's, I get why people do it. And in other states, especially Michigan, Michigan, it makes a lot of sense. Texas, people are still doing it, especially in rural areas. And I'm like, it's illegal, and people will send me something. It says contract for deed. And I'm like, what is this? I'm like, this isn't a marketable asset.
Yeah, that's the thing with contract for deeds in Texas. That it can be sold to an investor, but to an owner occupant, it's got to be only 180 days contract, or it's a illegal contract for the most part. But
right, and so I buy notes, and I buy performing notes, and that's a very specific niche, and people are like, oh, but I've got a great performing contract for deed. Why can't you give me 90% for that? Yeah, because whoever buys this is going to have to spend a lot of time and convert it into an actual mortgage, and the risk comes, is that borrower going to sign that? Are they going to talk to you? There's no telling. So, that's not a me problem. That's a them problem.
Well, and it comes down to where it's located. Like you said, it makes sense up in other parts of the country where you do have lower values.
Sure.
And you can't evict versus foreclosing. Like that's the beautiful thing about a lot of the states that are attractive. It's like Indianapolis, you can evict in 14 days on a contract for deed versus going through a foreclosure process. Michigan's the same thing. You're evicting versus foreclosing. Ohio, you're going to foreclose like you would a traditional mortgage. So, and that's the thing is so many states have different regulations out there. You really need to know where you're buying it and what falls into place there. And Robert asked a question: what should one consider when looking at contract for deeds? We'll talk about that later time. Or Robert.
So yeah, one last part about that. I will buy contract for deeds because I have the places to send those to. It's nothing I want to personally put into my portfolio. Everything that I would take down a contract, either it's going to a different institution, it's going somewhere, or it's staying in my own personal portfolio. I don't want to jack around with contract for deed. So, but I do know people who buy performing contract for deed. And so, yeah, I will go, I'll go broker it over there to whoever. But the important thing is, when people hear Capricorn pays 90% of unpaid principal balance, that is for a performing mortgage. That is not for contract for deed. It's not for a mobile home. It's not for a bare tract of land. It's a very vanilla niche product,
One final question for you, then we'll let you get back to your Saturday afternoon. Would you buy a note on a friend or a family member's property if it's already non-performing?
Okay, so it's on a family member? Would I buy
their a friend or family member's got a note and it's non-performing? Would you buy that note if it's their house?
I'd buy. Well, oh my gosh! Wait. Okay, now we're getting into something called mortgage fraud.
No. I would say it's mortgage fraud. If you buy a note, would you buy a note?
Right, but it's but it's the family is the borrower.
I believe so. That's what she's saying. I wouldn't.
Okay.
If I had a friend,
I'm not gonna get mixed up in something like that.
Thank you.
I mean, yeah. I mean, I buy anything at the right price. Damn near close to anything if it's at the right price. But something like that, where, gosh, non-performing notes. Yeah, it's probably having that conversation with a borrower who's not paying their mortgage. It's like my least favorite thing ever. And I can't imagine doing that with a family member. I mean, that would just be...
It's got to be at a big discount. You're going to have a different last name than the person on the mortgage. That's the first thing. We have bought a couple notes for students of ours or negotiate that, where it was a different entity and stuff like that, and restructured the note knowing that, but knowing if they didn't perform, we were foreclosing. And we negotiated that as a deed in lieu and escrow, basically. Like, if you're not going to perform, we're just going to wrap this up and let you go your merry way, and we're going to take the property back and go from there. So you got to be prepared to probably have a little bruised feelings, but like you said, avoid it and move on, right?
Don't mix family and money ever. I come from that type of family where, we just don't lend money to each other, and that's perfectly okay. That's how I was raised, and so I have a real aversion to getting involved with stuff like that. But for the right price, who's that lender? Is he willing to sell it for 15 cents on the dollar? I might be game for that.
Yeah, exactly. Well, hey, Kristin, thank you so much for coming on Note Camp. They're really delivering lots of thank yous from everybody out there. Guys, you can reach out to her. Best email, Kristin@capricornmortgage.com, correct?
That is correct. Yes.
And you can find her on all social medias out there. I think what you use, the Instagram is Hard Money Mistress. Is that right?
It used to be Hard Money Mistress, but now it's the Mortgage Mistress. I figured since I'm not, peddling hard money anymore, I should probably update my Instagram, and I've heard, here's the peanut gallery on this. They're like, the Mortgage Mistress, it's just not really as cool as Hard Money Mistress. I'm like, yeah, I know. I'm like, I'm just less cool.
There you go. Well, hey, thanks so much for joining us on here on Note Camp on Saturday. Enjoy the rest of your weekend, Kristin.
Thanks
So much.
Bye, everybody.